Hi tribe, welcome back to my channel. Today I am so excited, and actually I just want to give a little bit of a background how much I love the internet. I've seen this man over here on Instagram and on YouTube, and got so interested because he has so much information and so knowledgeable. So thank you so much for joining me, Omega.
Thank you for having me.
So he runs a platform called Money Mondays. Do check it out. I'll leave the link below to his Instagram and to his YouTube. So please do the right thing. Make sure that you go follow him. He has amazing information. So today we are talking about investing.
Yeah, my favorite topic.
No, I mean, I've seen it. I've seen clearly that it is your favorite topic. So I just want to start off by asking, why do you think it's so intimidating? Why do you think people are so intimidated by investing?
Well, I'd say probably one of the core reasons people are intimidated by investing is that they don't think it's for them. Long term in South Africa, investing was seen as an exclusive thing for the rich and wealthy, rich and wealthy.
Yeah.
So when something is inaccessible, it then gets perceived as intimidating, as in like you can't do it because you're either not smart enough or you're not rich enough.
Enough money to start doing it.
So people like get slightly intimidated because of that. And so that culture has stayed, even though now investing is quite open and anyone can actually do it, So it's going to take a while for us to get out of that culture of thinking that investing is a scary thing, but we're getting there.
Yeah. Actually, kind of reminds me from my introduction why I thought I should invite you, right? I have seen your stuff, really solid stuff, right? And I love the fact that, yes, currently, there's lots of people who are talking about investing, who are on YouTube, who are on Instagram, but I just always get the sense that, like, for example, one time I saw on TikTok, someone said, I'm not saying much, but I think you should go buy, for example, Checkers shares.
Yeah,
and I was like, hey, Bo, what do you back it up with?
Yeah.
How? And for me, that's the problem. I love the fact that, yes, there's more and more people who are talking about personal finance, talking about investing, but it has to come from somewhere. It has to come from somewhere. There has to be something that backs up what you're saying, right? And for me, that's what I get from you. So when did you start investing?
For me, obviously, investing is not. I didn't start as a non-professional, so what in the industry we call a retail investor.
Yeah.
I started out actually as a career as a portfolio analyst. So my job was mainly to do research and then provide it to the actual people doing the investing.
Yes.
So I think that's how most of us start in the space. Eventually, you earn your stripes, and then you get given a desk where you get to sit down, and you get given a couple of money capital, right? And then you get given a particular mandate. But when you start out, actually, you don't make the decisions yourself, the investing decision yourself. You get given basically orders that you're actually going to input and run for a bigger portfolio manager. Then at some point, you get told, okay, now you can run your own trades. You can make a few of your own decisions, but they have to stay within a particular asset class or between a particular theme. So for me, mainly it was credit, so it was bonds. I love credit because it's the easiest thing to analyze compared to, let's say, companies which are affected by like a diverse set of factors. So that's how I earned my chops. And then I eventually lost my job, and funny enough, it's so crazy. You'd work in the finance industry, but your own personal finances aren't well taken care of. Mainly for me, it's because I thought that my lovely salary would be there forever. I never thought I'd actually come back down once I started, So, you move to Sandton, you get a good job, and you're thinking, this is it. Now it's just upwards all the way. It turned out that's not how it works. You go up and then you get brought down. And when I came back down, I had some savings, but I actually had not built myself an investment portfolio. And so that's when I now started for myself. So this was around about 2015, where I really started investing for myself. And it coincided with Easy Equity's launch. And so I was like, okay, I'm looking for a cheap broker. There's a couple of stockbrokers that I did like, that I was familiar with, obviously professionally. But the fees were beyond what I was capable of personally. So I then started investing there. Took obviously what I had learned at school, what I'd learned on the job, to apply to my own personal portfolio, and it's been decent ever since. I've had some bad investments.
Yeah, I've
had
seen some from some of your videos.
Yeah, because investing is not a win-all game.
Yeah.
Sometimes you'll be wrong, sometimes you'll be right. Sometimes your ideas will be based on something that you think is true, but it turns out the world has other plans, or there's something that you don't know, and
there's information that you do not know at the time.
Worse, when you're investing on your own and you're no longer working with a team, what happens is you start missing out on a lot of information because there are things that you don't actually specialize in researching. So, for example, I have no knowledge on healthcare, right?
Yeah.
So it means if I research a healthcare company, I'm looking at it from the typical like investment case of, okay, cool, it has these certain factors, this is really good, this looks like a solid company, like a good business, because that's what we taught to evaluate. But somebody who has a background in healthcare or specialized in healthcare could tell you simple things like, I've been analyzing this drug research and this development within a university, and I know this is the pharmaceutical company that's going to be handling it, or I know this is the healthcare group that's going to be handling this, and they'll have better insights, and you'll be like, oh, okay, I didn't know that, and they'll tell you, listen, based on my research, I know this drug trial is going to fail, meaning this share is probably going to come down because this is the company that's linked to that drug trial. You'll be like, oh, I thought Aspen was just a good company, right? And the next thing you know, shares go down, and you're like, I didn't know that. And so for me, that was my experience. Going from the job to personal was actually a totally different game. The other thing that made it a very different game was that now it was my money on the table. And I wasn't obviously earning a salary. One of the things people don't get about being a professional is that you actually get paid a monthly salary. You don't get paid based on how well you invest.
Of course not.
Sometimes, depending on the firm you work for, you get a bonus if things go well, if things meet a particular benchmark. But most of the time, you get a very simple salary, and you're just doing research and analyzing, and then obviously initiating trades. But when I lost the salary, and obviously I wasn't managing a very big book, it was my personal book, what happened was I had a lot of stress. I thought I could live off investing because I was like, well, I'm a professional. I should be able to do this. Turns out that's not the case. And so I had struggles in the beginning, but long term things have played out pretty well. I'm fortunate in that way.
But I mean, I just want to take it back a little bit. You said you thought you could live off your investments. Can people really live off their investments?
It's one of those answers that has it depends. And I'll be straight. It literally depends on how much money you have as capital. If you have, let's say, R1 million, then you will live like an ordinary South African who earns about 15,000 rands a month. So one of the things that people tend to not understand is there are two types of millionaires. There's an asset-based millionaire and a cash flow-based millionaire. Obviously, you want to be both, but ideally, you want to earn $1 million. Yeah, you want to earn $1 million, not have $1 million in assets. So there's a lot of people in South Africa who actually have $1 million in assets. I think one of the best examples I always use with this is like our parents. Most of our parents have houses that are worth more than $1 million and are paid off. So technically, they're millionaires, but they don't live like
their house, right?
They can't cash out the house, and they're not millionaires in terms of their lifestyle. So can you live off your investments? Yes, you can if it's a very large amount of money. I'd say something like 2 to 3 million in liquid assets. Liquid assets meaning assets that you can sell and buy really quickly. But if it's assets that are illiquid, like say property, unless you're earning rent, you're not going to be able to live off it. That's just my opinion. A lot of people will say, well, you can trade daily or weekly and make money. That is possible, but not recommended for like 99% of people to do.
And actually maybe just tell us the difference between an investor and a trader, because I think sometimes people confuse the two. So does it mean that if I'm an investor, I'm sitting in front of my computer, have 5 laptops and screens in front of me? What does it mean, and what's the difference between the two?
In out there in the world, we do differentiate between the two, trader and investor. But essentially, both of them are doing the same thing. They're buying an asset and they're holding it for a particular time frame, whether it's a day, a week, a month, or a year, or 10 years,
10 years,
20 years, and then they're selling it at a profit.
Hopefully,
hopefully at a profit. Obviously, we hope that it's a profit. SARS has this nice term called capital gains. So they're selling it, hoping to generate a capital gain. So both of them are doing the exact same thing. It's the exact same function. What differentiates them is the philosophy, right? So investors most of the time go for the long term, right? So they literally want to become part of a company. So the reason we wouldn't call, say, someone like Warren Buffett a trader is because when he goes in, he becomes
holds.
part of a company. Yeah. Whilst a trader is really playing on price, they really don't care most of the time about being part of a company. They literally buying shares or whatever it is that they're buying, literally to sell them at a higher price, sometimes at a very short time frame, say like an hour or a day or a week. And when you're doing something like that, most of the time there isn't enough economic data to actually make decisions on. So you have to base your trades on something very different. Unlike an investor who will actually evaluate a business and then decide to be a part of it, a trader will evaluate the share to see how it's moving and then decide to trade it based on the direction, whether it's going up or down. So that's really the difference between the two. The function is the same, but the philosophies are very different.
The approach is completely different.
Yeah, the approach is very different.
All right, so what are some of the mistakes you've seen newbies do when it comes to investing? Because there's tons of them. And for me, one of the ones that I can tell you right from the get-go is people will listen to anyone or anything that says, oh, you know, I thought you should buy this share. Why? So for me, that would be one. What other mistakes do you normally
we
see?
like being told what to do as people.
True.
You know, we very, it's not that we're lazy, it's just that we sometimes have hope that whoever's telling us something has done, you know, the right thing, their research, whatever it is. So definitely that's one mistake. The other one is believing history can help you predict the future. So that's the standard. You know,
and I mean, even with on a fun fact sheet, they will always tell you
historical results do not
guarantee future.
Because they know that's something people do naturally. We want to look at, say, like a fun fact sheet, or we want to look at like the price trend and say, you know, it went up, so obviously it's going to go up again. You know, so we think like that. In basketball, we get something called the hot hand fallacy, where basically someone like just takes a shot and they keep going, and then people believe that they always gonna make like the shot. So with shares, we do the exact same thing. You know, we see it go up one day, we think it's gonna continue doing the exact same thing. So basing trades or investments on history, that's the first primary mistake. The other common mistake that people tend to make is they don't actually research companies. Instead, they listen to the news. All right, that's a very common one. They'll tune in at 10 o'clock and they'll say, hey, I heard this on the news that this is something that's going up in value. Let me go buy it. Or
they listen to the Money Show, because I love it when they do stock picks.
They listen to stock picks. There's nothing wrong with listening to stock picks, as long as you understand that you still have to go do your own research. One mistake that I tend to see is people will buy a good company, but they will not have a timeline that says this is when I'm wrong with this investment, all right? So a practical example of this is you can buy, let's say, ShopRite shares, right? And you expect them to go up, but because you actually don't know when you actually expect them to go up in value, you can see them go down for a while and then actually sell the shares before they actually go up, because you actually didn't set a timeline that says, okay, I'm gonna buy these shares and I'm going to wait for them for 8 months to go up, all right? So maybe in the last 2 months of my 8 months period, that's when I'm expecting them to actually go up instead of going up in a straight line, because shares don't go up in a straight line, you know, and that's the other mistake people make. They buy shares hoping that the price is just going to go up in a straight line, when instead prices go up, down because of market dynamics.
Do you know how many people have come back to me and said, Mapalo, I bought these shares on Easy Equities and I'm all in the red? And I think that scares people as well.
It's the simple fear reaction that people get to like seeing red on the screen. If you've never sat in front of like a trading desk for a very long time, you don't understand that red is part of it. In fact, every time you open a position, you're in the red because your broker charges you a spread and a commission. So it's natural to actually be in the red, right? It's the way it starts. It's the way it starts. The trick is to know how long you should stay in the red and when you should go green. If you don't know that, then obviously you're going to panic every day, because you're going to see things get red, and you're going to be like, okay, when is this thing going to turn around? If you're finding yourself asking yourself, when is this thing going to turn around? Then it means you invested without any knowledge about it. That's actually what it means. And it's a harsh truth, but that is the case.
Okay, then how does one go about researching? How do you pick a stock? So let's say you are a complete newbie, right? And you know you want to do this because you know there are so many benefits to investing. You are completely clueless. You have not studied finance. You have not worked in the industry. how do I go and say I'm going to pick a share when it comes to, and I'm not even talking about exchange traded funds, I'm not talking about unit trust, I'm talking about a specific,
an individual share.
An individual share. How do you do that as a person who's never done it before?
There's a lot of ways to do that,
Yeah.
but the way I always tell people to start with is to look at your own personal life. As humans, we all have some sort of intuition on things that are going on around us, products that we use, companies that we use. So it's very possible for you to just look at your own services and products that you use and determine who's actually providing me those services. Like, you can walk into a shop and realize that there's a certain product that is always not on the shelf, or there's certain products that is always being used. You can speak to your friends and discover that, oh, people are actually using this product quite a lot. Let me go find out what company is actually providing that product, and then start researching that company. So that's one way you could approach it, but obviously the most important thing is to develop a process. People lose money because they don't have a process.
So what would a process look like?
There's a lot of ways a process would look like, but the most simplest process that I believe people can actually adopt is what we call the macroeconomic process. I know the term might sound scary, but trust me, it isn't.
Now we're going into economics, economics 101.
It might sound a bit scary, but it actually isn't. It's very simple. Ask yourself about a theme, a particular theme. So I define a theme as a problem that humans have, all right? And then ask yourself, what group of companies are trying to solve it, okay, in various industries? So for example, energy. It's very simple. The world needs energy. There's more of us coming in every year, so population is growing. Our technologies that we utilize need more energy.
Cars are going to need.
Everything needs more energy. So the question then becomes for you, which companies are trying to solve the energy problem, and in what industries are they in? So you analyze the theme, and then you analyze the industries. And then your job, when you look at industries, just find 2 or 3 good shares within an industry that best service the theme. All right, and then from there, you analyze those companies and you have to evaluate them. Evaluating companies is actually not as difficult as it sounds, most of the time, because there are various technologies that are available online that do actually give you evaluations already that are done. And so you just need to understand how to interpret the metrics that you're being shown. And then from there onwards, you can set a timeline asking yourself a simple question. All right, here's a company. Now I'm going to buy the share. And this is the most important, like literally, if anything people can walk away from this episode, they can get, this is the thing. The company and the share are 2 different things, right? That is probably the thing that professionals understand the most. So the share trades at an auction. If it's a South African company, it will be at the Johannesburg Stock Exchange, which is really an auction for companies. And so meaning, just because a company is good, doesn't mean its share is good.
Will reflect
will reflect the exact same thing. Sometimes a share is overpriced, meaning that people at the auction, so us as investors, we don't want to buy it because it's too expensive, meaning its price will naturally go down. So you can't find yourself looking at a company saying, okay, this is a good company, but then you buy it at the wrong price. And then what happens, the price comes down, you panic, you think it's a bad company. No, the company is good. It's just that the price is too high for that particular share. So after you analyze a company and realize it's a good company, you then have to analyze the share price. Simple. Is it overpriced or is it undervalued? That's one question. But the most important question is this, and this is the thing that people can take away. When you look at the share price, it's a simple question. Ask yourself this: will this price be higher next week, next month, next year, or in the next 10 years than what I'm seeing today? If you can answer yes, buy the share. But understand, if you're saying it's going to be higher in the next month, then along the month, there's going to be ups and downs, right? But understand, if you say that's going to be higher at the end of the month, then wait till the end of the month to find out if you're right or wrong. If you know that's going to be higher by the end of next year, then have that patience to watch it go up and down, because then you are very self-assured because you know when you're expecting it to actually go up. So that's literally the most biggest takeaway. So when I sit down and I eventually get to the parts where I'm looking at the share, I literally ask myself a simple question. I'm looking at this share. Is the price going to be higher next week? If the answer is no, and I want to only hold for a week, I don't buy it. If the price going to be higher in December than it is now, cool, buy it. All right.
Regardless of what's
what's going to happen. If you can just get that, then you're sorted as an investor.
All right. So now, which brings me to my next question: when should you cut your losses? So let's say you've said, okay, by this time next year, this share price would have gone up. you
Yeah.
reach next year, December, this thing has not gone up. It keeps on going down,
Yeah,
and down,
yeah.
and down, and down. When should you cut your losses?
The way we determine to cut losses is we create rules prior to even buying the share. Okay?
I like that. I
So-
like that. I like rules.
Yeah,
I
rules.
like
Systems and rules.
structure.
Yeah.
Yeah.
So-
Clarity.
So in the professional world, we don't buy shares and then guess later and hope that, hey, this is how it goes. You're going to lose your job if you do that. All right. What tends to happen is we have rules for our overall portfolio that says if our portfolio goes down by, this is an example, by the way.
Yeah.
If it goes down by 20%, we sell all the shares and then find out what have we done wrong. Okay. So you can have a rule for your overall portfolio. You then have to have a rule for a particular theme or industry that if the shares I hold in this theme or in this industry go down by, say, 20%, I sell all the shares regardless of how well some of them are performing. I then do my research again and find out what am I missing.
Yeah.
And then you can have specific rules for specific shares where you'll say, okay, for a share, if it goes down by, let's say, 20%, I sell the share regardless of if I think it's going to be higher next year or in the next 2 years, or if I think a recovery is very possible. I sell the shares, cut the loss, redo my research and find out why I'm wrong. The lovely thing when you have rules is before you even go in, you know what losses you're going to expect. The same is true for gains. You also make rules for gains that if it goes up to this point, I sell. Even if I think it's going to go up even more, that's my rule. If it goes up by 10%,
But what if I'm
I
greedy?
sell.
What if I'm greedy and I think that, you know what, it's just going to keep on going and it's going and it's going and it's going?
Greedy people lose money in the market. Fearful people lose money because they sell too early.
Yeah.
Greedy people lose money because they sell too late. Right? They wait for too long, like they think it's going to go up, go up, go up, and then what happens? One day they wake up, it's in the red. They don't know what has happened to the company or the share, and then they've lost their profits and possibly their money. So the trick is to always have rules before actually buying the share. Know how much you're going to lose prior. Know how much you expect to actually make, and then you'll be fine. You're not going to panic because you know if, let's say, your rule is 20%. If it goes down by 5%, you're not panicked because that's within your rule bandwidth. You know, okay, it's down 10%, it's down 15, it goes up another 5. You know, it's still within my rule bandwidth. And then when it hits 20, sell, right, and then redo research.
Okay, now we're going to go back to you because you're telling me all these things.
Yeah.
And I watched one of your videos where you lost quite a lot and on a share.
Yeah.
What happened there?
I think that the share is into place.
Yeah.
So I had a particular thesis about housing in South Africa. This was about 5 years ago. So
Before even COVID.
yeah, this was way before COVID. So my thesis hypothesis, my idea basically was this. I knew real estate investment trusts were shaky, but I believe that into place because it's a residential real estate investment trust and the population is growing and people always need housing and a lot of their properties are in urban areas and the majority of South Africa's population is slowly like moving into urban areas. I didn't think it would be a company that has financial problems. Right, so that was my idea. So out of all the real estate investment trust, I believe that this is the one that's going to weather the storm simply because it's in residential while others are in commercial. I was wrong. Okay, I was just very wrong. It turned out that a few REITs, I'm not going to mention them, had financial difficulties that eventually affected the whole industry.
The entire industry.
And then there were a few political conversations that also then affected property evaluations. And then obviously COVID eventually came and that affected property valuations more. Obviously rental collections as well were negatively affected. And I effectively lost 50% of my investment in that company. In fact, it was slightly more, it was about 51%.
Did you set your own rules in
in
the beginning to say, okay, at this point...
I did have rules. Okay,
but you violated your own rules.
I violated the rule, but sometimes you make an exception on a rule based on incoming information.
Yeah.
So my idea was that, okay, there's going to be a mess up with the real estate investment trust, but Place is going to weather the storm. Little did I know, had I analyzed Place's financials just a bit more in depth, I would have found a massive debt hole in their balance sheets. The balance sheet, by the way, like just assets and liabilities, I would have found out that the company has a lot of liabilities and is obviously paying a lot of interest on those liabilities. And then their debt to equity ratio was horrible. They had quite a lot of debts compared to the equity, and that just slammed the company down. And the losses happened so fast that to get out of the trade, obviously now fear kicks in, where you see yourself losing 30% and you think, it's going to turn around. It's going to turn around. Yeah, it's going to turn around. Which is rule number one. Never think it's
Don't
going
do
to turn
that.
around. It doesn't turn around. It never does. By the time it turns around, you would have lost all your money, right? And so I thought, okay, it's going to turn around. You know what? Let me be patient. Everybody's going to realize what I know, which is Entry Place is a residential REIT. It's going to do well. It's a rental
And I'm going to
property.
be right at the end of
And
the
I'm going to
day.
be right. You never write against the market. The market is always right. And it went down even further.
The market always wins.
Yeah, the market always wins.
Yeah.
The old saying is, the markets can remain irrational longer than you can stay solvent, you know. So that's what happened. And by the time it got to 50%, I was like, okay, you know what, I'm done.
Yeah.
I'm just going to swallow
Let
this
me
one.
just take my losses.
And I took it. And it went down even further afterwards, all right? So had I
see.
stayed, I actually probably would have lost about 80% of my investment. So I'm glad I got out at 50, though I would have loved to get out at 20, you know.
You should have gotten out of 20.
Yeah, I should have gotten out at 20. So that's how investing can go wrong. And by the way, like, that's not a once-off. There are moments where I've been wrong, but not obviously losing 50%, like losing 5, 10, 15%, because it's part of my rules-based. And so sometimes that will happen.
But do you not think that's part of the reason why people are so afraid of investing? Because you can potentially lose your money. And yet, there is this other side where people will completely believe you if you say, invest in this, it will give you 40, 50% after however long.
Yeah. The fear of losing money is one that's very strong. And it comes with this culture of thinking that there can be an investment without any risk. All investments have risk correlated to their rewards.
All investments have risk.
All of them.
All of them.
You know, so risk towards ratio is the technical term. So whatever risk you have is related to the rewards that you want. So if you want guaranteed returns, it's not going to happen in the market. You're better off finding those elsewhere, which if you do find them, by the way, please tell me, because I'd also like to know where they guarantee with no losses, because I've been searching for that. Because that's like gold, you know, if you find it. So all investments have
And I don't think
risk.
anyone would tell you if they had found that type of
no one
investment.
will tell you.
So
I'd
I think
never
for me
share it.
also just a red flag when it comes to different types of investments that are available out there.
That people speak about. If anyone ever tells you that they've got something guaranteed and they're selling it to you, be very afraid. Run away from that. So there's no such thing as guaranteed.
But also I think it tells you just how we really don't understand investments, because most of the time I'll get people saying to me, okay, Mapalo, I've seen that you're talking about investing in shares. What is the interest rate that I can expect? So already it tells you that we really don't understand how the markets work. Why are stocks on the markets? Why are people selling shares?
It's actually very simple how a company ends up listed. So what generally happens is, let's say two entrepreneurs, we start a company, we call it M&O, and it's a company selling shoes, all right? So it's a company selling shoes, and the company's making a lot of money, you know, we got a lot of revenue, but now we want to expand across Africa. And so we've got two options of how to get money to actually expand. One is to go to the bank and take out a loan and maybe pay, say, 6-8% interest per year on that loan. Or we can go to the markets, which is the public, right? So when you speak of the markets, we're simply just speaking of people who are investors,
who have money,
and are willing to invest in our company. And let's say we need to raise a billion rands, and the company releases 100 million shares, pricing them each at 10 rand. So 100 million times 10 rands equals a billion. And then we sell those shares to the public. We list them for 10 rands each. And then members of the public buy the shares if obviously they believe in the company. And so literally companies generally go list on the JSE because they need money. And instead of going for a bank loan, it's better to actually get people to buy into it, because that money doesn't come with expectations of interest, you know. First of all, if you take money from a bank as a company, you have to pay back the money, the principal that you borrowed. And you can imagine paying back $1 billion is not that easy.
It's not that easy.
And paying interest on $1 billion is not that easy. So you can imagine for a shoe company, maybe our actual revenue per year is 50 million rands. So 5% interest on a 1 billion rand loan, before we make money in Africa, would all be our revenue. So it wouldn't work out for us. So that's why companies list on the JSE. Now, what happens after you've bought the shares is you now part of the company.
You own a piece of the company.
Yeah, you own a piece of the company. So it's a unit of ownership in the company. You then, just like the company sold the shares to you, can sell them to other people. All right. So this is the part where I've seen a lot of people get wrong. So these are one of the mistakes that people make when investing. They think when they buy shares, they are giving money to the company. When you're not giving money to the company when you buy shares, right? most of the time when you're buying shares, it's somebody else just like you
Exchanging.
selling
Yeah,
them.
yeah.
And the way money is made is by you selling them at a higher price. So where cash is generated for you as an investor is for you to simply sell the shares you own at a higher price than what you actually
bought them.
paid.
Yeah.
So you're the one making the money. When you sell or buy shares, not a company making money and then saying, okay, we're going to pay you this interest because you bought shares. Of course, that does happen through preferential shares and dividends, but that's a totally different issue.
Yeah.
But when you're buying just common shares,
Ordinary shares,
ordinary
yeah.
shares, you generating money by you selling them at a higher price. And so that's how it actually works.
Which actually brings me nicely to the next question. Why do some companies have, different types of, or the different classes of shares? Ordinary shares and preference shares, and which one is better, if I can call it that? I know there isn't better because it just depends on what it is that you're trying to achieve. Why do they have those different classes?
So companies will obviously choose, will issue preferential shares and common shares for various reasons. Most of the time, preferential shares are released in order to take in capital from people, but without having to give them voting rights. So if you're a preferential shareholder, you can't vote at an AGM because technically the company owes you money. And so there'd be a bit of a conflict of interest if you're a shareholder who can vote at the same time you owed money. So preferential shares come with a few benefits. First of all, most of the time you get paid a fixed dividend. So if you want to guarantee the dividends that you earn from a company, you buy preferential shares. And of course, you paid your dividend before common shareholders, right? Simply because your shares are a mix of debt and equity. So it's like you borrowed the company money, but at the same time, you're a shareholder, right? So that's how preferential shares work. But you can't vote at AGMs. Unlike common shareholders, who are technically the ones that owe you money when you're a preferential shareholder, they get to vote on decisions because obviously their money is really affected by what happens at a company.
But also depends on how many shares you hold. You can't just be holding one share
and vote. You can. Yeah, you can. So most of the time for non-professionals, if you have like a brokerage account, you'll see them send you a proxy form. Yeah, they'll send you a proxy form that you then can fill in, and then somebody will vote on your behalf. They'll vote and make a decision that benefits you as a shareholder. So decisions that shareholders vote on are generally always straightforward, and generally it's very easy to see which ones benefit shareholders and which ones don't. Yeah, so proxy will go vote for you. However, if you do want to attend yourself an AGM, then you can more than email the company. Your broker will assist you get verified by the company that you are a shareholder, and then you can walk into the AGM and sit down.
Say, I have my one share, and I'm going
doesn't
to vote.
Matter how many shares, as long as the whole share. So it can't be
not
a fractional share.
Shares.
Not fractional shares. So
Yes,
as
I
long
think
as
that's
the
a
whole
difference.
share.
I think that's
then you can
big
sit
difference.
at the AGM, listen to the big heads.
Okay, so
talk.
fractional shares meaning if you're investing through easy equities, you normally hold fractional shares, right?
Obviously, some people will buy fractional shares because it's a lot easier. For example, if you're buying Capitec shares, most people will buy them as fractional shares because they don't have like over 1,000 and more to buy one share, right? So that'll be the case. But most shares will be 50, 30 rand, 70 rand, 120 rand. You can buy whole shares of those and get an AGM invite and then sit down and listen to them talk. Obviously, the amount of shares when it comes to influencing voting,
something else.
Yeah, that's something else. If you own too little, then your votes don't really
All right.
count.
So why do some companies pay dividends while others don't?
It depends. It mainly depends on the company's maturity. So some companies are very mature, right? So for example, ShopRite is a very mature company, and the type of business they're in is very suitable for paying shareholders dividends. Other companies prefer to take profits, reinvest them back into the business, because all dividends is taking profits and then dividing them among shareholders. I'm sure we can hear the name dividend. That's all it is. It's dividing profits among the shareholders. And obviously, if you own little shares, you'll get dividends equal to the shares that you own, right? So that will be the case. So most of the time, it just depends on what the company wants to do with the money that it has. It wants to redeploy it back into growing the business with the hopes that one day it will declare a dividend. We've seen a few companies on the JSE declare what we call a maiden dividend. So that's the first time where they're paying out, and it's mainly a glorious occasion. It's finally 5 years I've invested in this company. Now they pay me, and because the company has matured, they've grown, they've started making quite a lot of profits, and they feel, okay, now we can give some back to shareholders. That's one way companies give money to shareholders. The other way is they'll do what we call a share buyback. This is very popular
had those,
globally,
yeah.
where companies buy shares
back.
from you at a higher price than generally what you paid. So
Why
that's
do
why
they do that?
There's a few reasons why companies buy
Buy back their shares.
Yeah, buy back. Sometimes to give shareholders back money in the form of a buyback. Dividends do carry a certain type of tax, dividend withholding tax. So sometimes it's
15%.
beneficial. Yeah. So sometimes it's beneficial for companies to actually buy back shares than rather actually issue a dividend to shareholders. So that's one way. The other reason companies will buy back shares, sometimes literally just to raise the share price by decreasing the amount of shares in circulation.
They have in the market.
Yeah, so that'll be another reason. Sometimes it'll also be for administrative reasons. Like for example, you'll get a big shareholder who wants to own a bit more of the company, so they want to get shares bought back, and so that will be the case. But there's many reasons why buybacks happen, but most of the time it's to reward shareholders.
I absolutely love that. You know, like my mind is just going in different directions,
Yeah.
but I'm looking at the time. I'm like,
Yeah, I'm sure they're still watching.
I don't think we have enough time.
Yeah.
All right. So let's say you want to invest offshore.
Yeah.
Why? Okay, maybe let's phrase it in this way. You invest in South Africa and you believe that South Africa is going somewhere. But South Africa is a percent of the entire world.
Yeah, very small percent.
It's very, very small percent. Why is it important to invest outside of South Africa? And how can you go about doing it?
It's mainly for risk management. So when we manage risk, so there's a nice term called hedging. Basically, when you hedge is you spread your risk across different non-correlated assets or non-correlated countries or regions.
Markets.
Just in case one of them goes down, then you hope the others stay afloat or go up.
Yeah.
All right. So that this is mainly to diversify and to hedge risk. So the core reason to invest outside South Africa is obviously if South Africa's economy is under threat, you don't want all your eggs in one basket, all right? Now, I'm not saying South Africa is under threat. In fact, we have a very good economy that is very underestimated. South Africa is probably one of the most underestimated countries simply because, in my opinion, we don't brand ourselves very well as a country. We're very transparent with our problems. And so when people see that...
So we must lie.
Yeah, not lie, but we must tell a good story,
I hear you.
Along with the negatives, we must tell the good stories. And we're a country that doesn't tell our good stories very often. So we're very underestimated in terms of our future growth and our future value as a society. But South Africa has a lot of potential. However, there are risks investing in South Africa. There are numerous risks. And so it's very prudent to have your money in at least 2 other countries. Now, if you want to go about doing that, there are a few ways. If let's say you use South African brokers, most of them will offer some form of account that is overseas, so an American one or a UK or an Australian account. So that's very easy. You open an account with those brokers, deposit money, buy shares in those countries, and that's it, you're done. Another way is to obviously open up an account strictly with a company that is overseas. The most common company that people do it with is Interactive Brokers, though I wouldn't recommend it for most people. I'd say just rather stick with something simple like Easy Equities. Their systems can be Interactive Broker systems can be slightly complicated, which is unnecessary for most people. So it's very easy to invest outside of South Africa. It's actually not complicated at all. It's literally opening up a brokerage account, depositing money, and then buying shares in those various countries. You still then have to do research about those countries, about those shares, the same way you do in South Africa. And obviously try invest in countries that don't have an economy that correlates too closely to South Africa. So for example, Australia and South Africa are both what we call commodities-based countries, meaning we produce gold and other commodities, silver, zinc, copper, palladium, rhodium, whatever it is. So our economies are driven a lot by commodities. So if you're going to invest outside South Africa, try find an economy that's driven maybe more by companies than by commodities. So if you look at South Africa's economy in the last, say, 8 months, our miners have saved us. They've brought in money to the fiscus. They've made our economy and GDP grow.
Even at that point.
So because of the miners. So imagine now the miners weren't there. We're facing quite a bit difficult time. So Australia is a country that's similar. One that isn't very similar is, say, the UK or the USA. Very intense on companies. And so that's the way you want to diversify your risk. But South Africa is a good place. But have your money outside South Africa as well. It will benefit you.
I love that. Very patriotic.
No, go South Africa.
All right. So now there's whispers of a recession coming.
Yeah,
right?
yeah. There's been whispers.
There's been whispers, whether it is coming or not. But let's assume that there is a recession coming. If you do have some money in your money market, what should you be doing right now?
If the recession, I'll say this: a recession is coming. Simply because market cycles work that way.
Yeah.
Boom,
And
bust.
you've seen,
you know, they come,
the indicators
they go,
are there.
you know. So a recession is coming. When it's coming, we are not sure. And so I wouldn't say to people right now, sell all your shares. There's a recession coming next week. That's not going to happen. When the recession does come, it will be very clear, and so you'll have clear indications that now it's time to take your money out the market, sort of let prices come down. By the way, most people tend to not understand what a recession is. A recession, so recessions have, so the term recession applies the same in different spheres of the economy. So within a country, a recession is basically when you've had a few terms, economic cycles, where there's negative growth, right? So that's the recession. So say South Africa's growth just decreases quarter by quarter, there's negative growth. In the markets though, where you enter a recessionary period, or what we call a bear market, is when prices tend to go down 20% below the last time they were low. Right, so there are very clear indicators of that happening when it does happen. So you don't have to sell your shares now. You will see it when it happens. You'll wake up in the morning and it'll be very clear that, you know what, prices are dropping so fast, it looks like a recession is coming. And a recession is in fact beneficial to investors because prices of assets come down, all right, and then you're able to reevaluate those assets to see who's going to make it past the recession. So that's why I can buy shares now while they're low. It's almost like getting 2020's market crash again, you know, where prices came down and we were able to buy amazing assets for very cheap, and then prices came back up. The last recession, global recession we had, followed one of the most amazing bull markets. So a bull market is when prices just go up, right? So for the last 10, 12 years, the world has been in an amazing bull market. Prices have just been going up and up and up and up. So we know odds are that's what's going to happen after this coming recession. So people shouldn't be afraid that, oh no, a recession's coming. Does it mean I'm going to go broke? Your biggest fear in a recession is losing your job. Because you can easily protect your investments. So if you don't lose your job, you're fine. Just take your money out of the market, wait for prices to come down, and then re-enter. Now,
how do you know? How do you know when to take your money out of the market? Because I think I want to be very cautious with that advice.
How do you know?
How do you know that, okay, this is the time to take my money out of the market? Because, I mean, investment 101, don't time the market.
Don't time the market. The first key indicator that if let's say you invested in South African shares, you'll see the JC top 40 go down by 20%. If you see that, that is generally an indication that what's going to follow next is going to be horrible. All right, so that's one indicator I'd say watch. Most non-professional investors don't understand the concept of benchmarks, that there are certain indicators we watch that benchmark shares to see what's actually going on in the market. The most popular for South Africa is the JSE top 40, which is the top 40 shares on the JSE. If they start not performing very well, it's very simple what's going on. It means somebody's selling them. They are selling them for a reason. So you as an investor whose job it is to buy shares and sell them, if people are selling, it means no one is buying. Meaning just slowly withdraw your money out and be patient and watch. So those are the sort of indicators I'd say watch. Of course, you can't time the market. At the same time, you can't say, since I can't time the market, I'm just going to watch. Because, you're going to get wiped out if you do that. And that's not a good decision. Unless, of course, you're planning on holding your shares for the next 20 years, then please hold. Don't worry. You know, you're going to go past the recession. You're going to laugh all the way through because the shares are going to come back up. You know,
so also that can be good advice as well.
Yeah, that can be a factor,
All right, okay. So obviously we've mentioned easy equities, but how else can people access the stock market if you don't want to do it through easy equities?
So obviously there's broker accounts, right? So easy equities is a broker, and the broker's job is very simple. You place an order on their platform, they then go buy the shares on your behalf at the exchange and then put them in your account. There are plenty other brokers in South Africa. The reason easy equities is the most popular is because of pricing.
Way more affordable.
Yeah, it's way more affordable in terms of the entry barrier, right? So in terms of like the amount of money you have to deposit, to start, it's very low. And of course, the amount of shares you can buy in one single transaction is very low.
Yeah.
Unlike with other brokers where you will get instructed that you have to buy maybe a minimum of 10 shares to actually enter a trade. So there are a lot of other brokers. There's FNB stockbroking, ABSA stockbroking. Most banks have a stockbroking. There's PSG,
as
there's
well.
ShareNet. There's a long
Tons,
list of them.
tons.
Yeah, there's tons of them. So shop around. I always tell people shop around and shop around for a company that suits your objectives. So not all stockbrokers have the same type of service, but they all will do the exact same thing, which is to help you buy and sell. That's literally it. But another way to actually invest in shares is through maybe ETFs. Sometimes if you don't want to be active, looking at shares all the time, once a month, then just rather buy ETFs.
The basket.
Because ETFs represent a theme, all right? So they'll have a common theme of companies that are related to one another, and then you can actually buy just a basket of shares that relates to that theme. So if you know, obviously, something like property is always going to be needed, then you can buy a property ETF. If you know,
you can buy the top 40,
top 40 as well.
Earlier.
So you can. There's a lot of ETFs in South Africa that you can buy that track various themes, and so you can also do that. Another way, obviously, you can give it to a unit trust and then have them manage the money. It all depends on what your objectives are. I actually always say do all the options, right? Have a portion of your money with a unit trust, money that you don't necessarily want to worry about for a very long period. Buy some ETFs, so that's where you can have a fund manage a particular theme for you, especially if it's a theme that you believe in a lot. So for example, if you believe in renewable energy, then rather just go all in on an ETF than rather trying to pick individual shares, right? It's a lot easier and it's a lot more efficient to do it that way.
Kind of reminds me of the, not a recommendation, but the Signia Fourth Industrial
if you believe in the whole thing. Back then it was a very popping share.
Very much so. Made some money from there.
A lot of people made money from Signia ETFs. They're very good.
Very good.
So that's one way. But then obviously open up a brokerage account. Have a little bit of money for yourself that you invest with, that you will then enjoy actually just playing around a bit in the market. The reason I encourage people to invest is not actually to make money. That's secondary. My main reason to encourage people to invest is because of who they become while investing. You do a lot of research, you start learning a lot about your country, you start learning a lot about economics, which is a very simple subject, by the way. People tend to think economics is very complicated. It isn't at all. And when people are invested in a country, so we call it SA Inc. If you are invested in SA Inc. through owning shares that are South African, you'll care about what happens in South Africa. You'll care about the future of the country. And I think, this is now just my opinion, a lot of apathy in South Africa comes from the fact that we're not invested in South Africa. We don't have anything to lose. Most people don't. And so when you get a lot of people starting to invest in South Africa, now they have something to lose. Now they care about the country. So that's a very key factor. Then, of course, at the same time, while caring about the country, you can make some money.
Make some money while at it.
Why not? So
I love that view. I love that view because I think when we talk about investments, it's always about what can I get out of it, but especially monetarily. But now you're saying it's so much more about you, who you become as a person. And for me, I love that. And I always, even on this channel, talk about just becoming an entrepreneur or doing your own thing. It's not so much about the money that you make, but it's about everything that you become. And I absolutely love that view. I've never seen investing in that way. So thank you for that. For me, that was like a light bulb moment for myself. All right, so we're almost at the end. So which books can one read to...
That's such a tough question.
Just a few. I know it's always such a tough question, but just ones that come up to you right now.
You know how tough that question is because I'm not good at storing book titles. But anything written by Warren Buffett on value investing, Charlie Munger, which is Warren Buffett's partner.
What about
that's very good.
Something Graham, his mentor.
Stephen what?
Who wrote? I see now.
Warren Buffett's mentor.
Something Graham. He also wrote, because Warren Buffett says that it's the best book on value investing. He himself says it's one of the best.
Obviously it's his mentor, so obviously he's gonna say that. But anything by Warren Buffett, anybody within the value investing space who manages obviously a large amount of money like Warren Buffett does, that'll be a good place to read. Other books that I'd actually mention as well is you can look for stuff by Drunken Miller. He's a hedge fund asset manager in the United States. He's got quite a few books. There's Ray Dalio, amazing asset manager as well.
One of the most popular
and
ones.
then there's the CEO of Pershing Square. Actually, just his name literally slips my mind. It's Bill Ackman. Bill Ackman.
Yeah.
He's got books as well. Very lovely economic books. So I'd say any one of those authors, you'll get quite a lot of value.
And I think
from
also
them.
maybe even it's more than just about books. You can read on their websites. You can read articles they've written. So there's quite a lot of information.
You can watch what they do.
Yeah,
that's the most important
absolutely.
thing.
One that I'm absolutely loving, Kathy Wood.
Yeah, obviously ARC CIO and CEO.
Man,
Kathy Wood is a star.
She is
Kathy
a
Wood
bloody
is
star.
I'm
Absorbing. I'm watching so much of her material. It's insane.
Amazing, meticulous researcher.
Absolutely.
Yeah, Kathy's very insightful on her research capabilities and seeing things.
Yeah.
So definitely,
for the future.
Kathy Wood. If you're a non-professional, I definitely say watch a lot of what Kathy Wood does. And when you watch her, don't just read obviously her material and watch her videos. That's one part, but also track her various ETFs. Open up those fund fact sheets, read what they say. ARC publishes research, which is very lovely. So you'll always get to know what they're thinking. So one of the ways people always ask, like, okay, what's the first step in doing research? I don't know, because I don't have a brain like an economist or whatever. What do? I always tell people the best thing to do is just go look at a lot of fund fact sheets from ETFs, and you'll see ideas, all right?
Absolutely.
You'll see what they're doing, and then you'll see, okay, what resonates with you and your objectives, and then you can start investing. And obviously research from ETFs that they publish, you can read that, get ideas from that research, and then do your own research now with a place to start that is very clear, that you also know comes from a very valid source, because it's an ETF manager, so they're going to be very valid, right? So that's something I want to say do. So ARC is a very good source. In fact, I use some of Kathy Wood's principles when it comes to investing.
I know. I'm obsessed with her. And another resource I think also we can tell people about is Moody's Fool. They have really good research as well. But there's so much information out there. Just pick one or two that you can focus on, that you love, and just go after that. Because I think sometimes we have analysis paralysis. We're like, that's just too much. I don't know where to start. So
with South Africa, I would also say just to add, if you want to observe what's going on, MoneyWeb. Read articles on MoneyWeb.
Do you think it's worth it to subscribe?
To MoneyWeb?
Yeah, the subscription.
To
any because I follow the Finance Ghost as well. They do have a subscription. MoneyWeb has a subscription, and I know other companies are trying to bring on the subscription method where we're saying, okay, we're going to give you more information, more value. Do you think those are worth it?
I wouldn't say it's a case of worth it, but I'd rather say how much money do you have as an investor? So one of the things I always tell people is that investing is a business, and it's a business with business costs. So if you're going to subscribe to something, is it taking money away from you in terms of the returns you make? So let's say you subscribe to MoneyWeb, I know, 63 rands, which is 630 rands a year. If you have a portfolio of 10,000 rands, it's too expensive. It's taking away 6% of your portfolio just to get information. That's too expensive. Most funds, they management fees 2%, simply because that's where they pay things like rent, research costs, and all of that, salaries, etc. So for you as an individual, you should run on the same premise that, okay, out of my total portfolio size, I'll only dedicate this much money to services that give me information or research capabilities. And I'd say the maximum that you should be spending is 2%. So if, like, in your 2%, you can't afford any of these services, I'm sorry, you shouldn't be you shouldn't be paying them, simply because you should rather be focusing on getting more returns out of your money. But a lot of them are very good. So if you do have the money and it doesn't take away from your portfolio, then definitely subscribe. MoneyWeb has a lot of value in terms of tracking your shares and a few other things as well. But their articles on their own are good enough. As long as you read them early before they become hidden.
I hate it. We go on there. It's like, this is what
it's for gold subscribers. Before they get hidden, read them early and then you'll be fine. Take down notes.
No, fantastic. Thank you so much. So now we're going to go into a little segment just to bust some financial jargon. All right. So oftentimes we hear about PE ratio. It's going at this PE, it's expensive, whatever it is. What is the PE ratio of a company and why does it matter?
PE ratio is actually a very simple concept. It's how much money are you paying for each rand that the company generates, right? So if, let's say, the company has a PE ratio of 5, it means you're paying 5 rand for each 1 rand the company makes. So the reason we use that to judge a company is we're trying to evaluate.
And what's the benchmark also?
Benchmarks actually differ across industries and sectors. Okay, so this is a mistake that people make. They'll say, I want companies that have a PE ratio of 10 because that's generally seen as positive. Positive in the sense that the company is underpriced.
Yeah.
So they'll want to invest in that. But you'll come across an industry where PE ratios don't go below 40. Something like tech, where companies are so overvalued overpriced for good reasons, because they generate revenue like crazy. And people are willing to pay a lot more for Amazon shares than, say, like a shopping retailer, because Amazon it scales better than a shopping retailer. So you have to compare PE ratios across industries, and that's not very difficult to do. So just understand there's an industry average for that particular company. And then what you want to see is the company I'm looking at, is it below the industry standard, or is it above the industry standard? If it's above the industry standard, then the next thing you have to watch out for is this company overpriced? Meaning, does the share price have a chance of coming down because maybe people want to take their profits, or maybe because people think the company, actually the shares aren't worth the price that they are? So those are the sort of risk you'll watch with the PE ratio. If it's obviously undervalued, then you have to find out why is it undervalued. Companies get undervalued for mainly 2 reasons. Either it's people don't realize the company has value, or the company is bad, right? And so
how do you know which one?
And most of the time you look at the balance sheet, look at debts and liabilities. You look at revenue as well. Is revenue growth slowing down? Is revenue itself slowing down? Is profit slowing down? That will tell you if a company is on shaky ground. Because PE ratios drop as investors sell more shares and start to ignore that company. So a low PE ratio doesn't always mean the company is undervalued. It also just means investors don't like it. A high PE ratio doesn't mean the company is good. It just means maybe for a historical period, the company was good and investors did like it, and it's taking a bit of time for the PE ratio to catch up to the reality that the company has. So definitely PE ratio, price to earnings ratio, by the way, that's what it is.
Yes, I forgot to mention. I'm busting
price to earnings ratio. And you can hear the term price to earnings.
Yes,
so the price of the share compared to the earnings, how much money are you paying for each 1 rand the company makes? If you're paying too much money for 1 rand, then you know the company is overvalued. If you're paying very little, then you know something might be wrong, or something might be really good, and then you can buy that company. So that's what a PE ratio is.
All right, fantastic. So I'm going to say this one out. What is earnings per share mean?
EPS. So it's actually, it's not similar to the PE ratio, but it actually does almost like a similar job in a way. So earnings per share is very simple. You take how many shares exist of a company, and then you divide it by the amount of earnings, and then you get a number that correlates to 1 share. So let's say the earnings per share is 1 rand, just to make the maths easy. Right. So that means for each share of this company, when you take the earnings and divide it by the amount of shares, each share theoretically earns 1 rand. Obviously, what you want is an earnings per share that is high, because it means revenue is high. That means that's a good company. So earnings per share is very simple to tell. If it's a high number compared to its peers, then that's a good company. If it's a low number compared to its peers, it's one of 2 reasons. It's either a company going down, or it's a company on its way up. Right. So you'll notice a theme. We're always comparing companies to their peers. All right, and then we say, are you above your peers or are you below your peers? If you're above your peers, it means you're doing well, or you're about to not do well. If you're below your peers, it means you're doing well and you're on your way up, or you're on your way down.
Way down.
So that's always what you want to be able to tell with our companies. And so one of the reasons some people will actually lose money when investing is they'll find a good company, but they won't compare it to their other peers and actually discover there's better companies within the same industry, which will gain more because they're better than the good company that you found. So you'll find share prices of a company like simply going down, not because the bad companies, but because investors care about other companies in the industry a lot more. So that's something an EPS, an earnings per share, can actually help you with.
Awesome. All right, then the last one, return on equity.
So ROE.
Yes.
Yeah. So return on equity. So we have to first define what is equity. Right. So equity is your ownership in a business, basically your assets in a business. So it's basically the assets that exist in the business how much are they generating in returns. That's all it is. So the way, when you analyze a company, one of the things you want to look at is, okay, this company has XYZ amount of assets. How much income or revenue are they generating from those assets? And then obviously you'll see if it's a low return on equity, then it means the company is not utilizing its assets properly, or there's something wrong with its assets. And as an investor, you should be wary. Again, it's a comparison with peers, right? Yeah. So some companies, if they have the same types of similar assets, you'll see them have similar ROEs. If the company is way below its peers, then you need to find out why. If it's way above its peers, then you need to find out why. It's maybe performing very well, or they found a way to actually monetize their assets very well. So the reason it's important to look at industries is because companies' assets are not the same, right? So ShopRite and say Apple are not the same. They're not the same businesses. The margins of Apple as a tech company are insane. Massive. So the ROE will be very much insane compared to, let's say, ShopRite. Or if we put it into another American company compared to, let's say, Walmart, right? So you can't judge the ROEs of Apple and Walmart the same way because they don't have the same type of assets on their book. So ROEs help us compare companies with their peers, that who is utilizing
sort of apples with apples.
Yeah, apples with apples. And the question is simple: who's utilizing their assets the best, and thus giving more returns on equity, meaning more returns for shareholders. And so that's what an ROE is. It's very different to an ROI, which is return on investment. That's another thing. That's basically,
okay, maybe we can finish off with that then.
That's the capital you put in.
Because I know that's one also people love quite a lot.
Yeah. So return on investments is the simplest one to understand. It's basically how much money you're going to make from the investment that you've put in. Right. And so basically, most of the time, what you'll look at the ROI of an actual company. How much money have they invested in their business? And then you'll see how much returns they're getting. And then obviously there'll be your ROI as an investor, money that you've put in, and you want to compare if you're getting the same type of value, right? So if a company has invested very well in its business, as an investor, it should eventually translate to your own share value. So you want to make sure that matches up, and so that's how ROI will work out for you.
Oh, fantastic. You know, we can have this conversation. And the thing about investments, there is so much. There's so much. But I think today we covered the fundamentals and the foundational stuff. Thank you so much. And I can see how passionate you are about investing.
Love it. It's what we do, so we have to like it.
No, absolutely. So like I said, Tribe, please do go to his channel. I'll link his YouTube channel and his Instagram account, even TikTok. We spoke about it a little bit. TikTok, just go follow him. He has tons and tons of information, and I know that you are just going to soar. Thank you so much, Omega.
Thank you for having me.
Awesome. Bye.